So hello everyone. Indeed, the purpose of this presentation is not to complain or to cry all day long about the election of President Trump, but to try to make money out of it. And this is, I guess, a reason why we are all in this room. So I think, to me, there were two main things about the end of the year. Indeed, the election of Trump. But maybe I will start with not talking about Trump for a change, and talking about OPEC, and not about equities, but about oil. So I will start with the first theme I want to talk about quickly is oil. Then I will talk about Russia, that I really like. Then we'll go into Trump only on the third idea with the regulation in interest rates. And then I will finish with volatility that you heard a bit already in the morning. So let's start with oil, actually. So one of the events of the end of the year has been this OPEC meeting, right? At the very end, I think it was in December. So where the producers finally agreed to cut production by 2%. Quite an event was that finally Iran and Saudi Arabia agreed on something. Okay, I think this is quite a phenomenal news, and of course this has an impact for oil pricing. Since then, here this is the price of Brent. You can see that since then oil is stabilized at $55. Of course, there are moves up and moves down, but I guess this is quite stable. And even when the market is down a little bit, like it was the case yesterday, OPEC just comes in and says, no, if we need to cut more, we will cut more. We make sure that everyone respects the agreement. Okay? So I think we can be quite confident that this year oil should stabilize and should be stabilized. So it's a great year, I think, to sell puts on oil because volatility is still high on this asset class. So this is what we want to propose to you. So the first way of exploiting this will be just a normal autocallable. First, let's look also at the consensus of the main houses for the Brent price for this year. You can see that this is Bloomberg data. Everyone agrees. Of course, there are some outliers. There are, plenty of hope, I guess. But those ones are more consensual. So we've got an average stable oil. Don't think you should expect oil to go up. Anyway, it's a very expensive bet to put on, given the contango. So don't play on this, but sell puts. This is the right trade, I think. So on oil. So what I want to show you is a very simple product that you all know, how to make 10%. I've heard during the break, a lot of people came to me and asked me how to make money. So this is the first idea. You can make 10% per annum, so 9-month product, okay? A product that you know very well, all of you. It's an autocallable, 10% per annum, 70% barrier, okay? So it's quite low. It corresponds to the lowest of the consensus in Bloomberg. 9% per annum, 9 months only. Okay, so here you can extract a lot of yield via a very short view on oil. This will be on the worst of Brent and WTI. Okay, so I start easy with a very simple idea. So far so good. 10% per annum. So that's 10% per annum made for the people who ask me questions. Another way of playing the same theme is using, obviously, the oil companies. What you observe, so first I have to apologize with this graph. There is some mistake in the x-axis. So this period is 2000, so oops, sorry. So actually this period is 2014 until here. This is 2015 up to here, and this is 2016. Okay, this X is wrong. So there was a problem in the print. So what you see is that the earnings of oil companies tend to lag oil pricing. Nothing very new here, but I just show it to you. So if you believe in oil being stabilized at this level, you expect this EPS to come up. If you expect oil to go up, you expect EPS to lag, but to come up as well. Okay, so if you believe in the story that OPEC has convinced Saudi Arabia and Iran and Iraq to cut production, another way of playing it is also with oil companies. So you can generate an 8% per annum. So here you're a bit less greedy, via a structure that I hope all of you traded in 2016, because it was quite a bestseller. So maybe I will spend like a couple of minutes to explain this structure that we pushed in 2016. So the structure is called a step-down autocallable. Okay, so it's the autocallable as you hopefully all know it. Okay, but the great thing about it is that your autocallable go down and down and down and down at each observation level, each observation date. Sorry. So if I take this example, so I've got a worth of autocallable on Chevron, Total, Royal Dutch. Okay, 3 out of the 4 biggest market cap in oil companies. I'm not going to write an autocallable just like this. I'm going to write a step-down autocallable. So meaning, it pays 8% guaranteed. This is in USD, and I can be autocalled every quarter. Yeah? First quarter, I don't get autocallable, so I don't observe the first quarter. Okay. Second quarter, I'm here. I observe at 100% as usual. But starting from here, my autocall trigger level is brought down dramatically at each observation date. Okay. Which means that at some point, hopefully, if I'm not totally wrong, I will hit this autocall trigger. Okay, because it goes down, 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 down. Okay, so even if why we want to do this? We want to avoid the wrong call or the wrong timing, obviously, because as you all know, the worst thing that can happen to you is this kind of scenario where you go this way and then you drop, or you go this way and this way, right? Here, the roof. The autocall roof is going down and down and down, okay? So we are going to hit it, hopefully, soon. Yeah? So this is a way of implementing our view, I mean, a consensual view, I would say, on oil, so with a step-down autocallable. And I expect everyone here to have traded this one, if our sales were good enough, which I hope is our. And how low the bar is, how low 60% is, historically, on those 3 stocks, this is where it is. Yeah? So we are at a low. I mean, it didn't reach this level even when oil was at 26 or 27. You could feel confident that this product is going to behave well. On top of that, you add the step-down feature to make it even safer. And still you generate 8% per annum. Yeah? So this is the second idea on oil. So so far, no Trump. So now I'm going into my personal favorite already, which is Russia. I think, and it was already discussed quite a lot this morning, all the stars are aligned for Russia. All the red stars, actually, are aligned for Russia, really. If we are talking about purely the Russian economy, inflation is decreasing. It's the anti-US, right? Capital outflows are dropping, and the budget is strengthening with higher oil price. As you all know, the budget of Russia is highly depending on the oil level. In geopolitics, and much before Trump was elected, by the way, the role of Russia is quite has expanded quite a lot. We all read, we talked about Ukraine this morning, but I haven't heard about Ukraine in the news for the last 18 months. This is only my investor's point of view. Nobody cares about Ukraine anymore. Crimea is Russian, done. This is only my personal view, okay? So I think the place that Russia took in the world is phenomenal. And before Trump, just Obama doesn't really care about what's happening in the East. Now talking about Trump. Secretary of State, as you know, is Tillerson. So Tillerson is the CEO of ExxonMobil. Tillerson was decorated by Vladimir Putin in 2011. He's got the Order of Friendship of Russia. He had a great deal with Rosneft, a $500 billion contract to explore the Arctic with Rosneft that unfortunately didn't go through because of the sanctions. So now you can see that what may happen for ExxonMobil, what may happen also with the sanctions, but it's only a personal point of view. So this is also the Trump effect now, okay? The oil effect and the Trump effect. So rising oil price and probably less sanctions. Just for the sake of being in line with the previous speakers, I put some tweets by Trump about Russia, always very, very deep. So the first way, and I think my personal view is the best way of implementing this view, is going long ruble. Some houses, including Swiss, quite big Swiss banks, say that the Russian ruble is the most undervalued currency currently. And I tend to agree. With all the previous arguments, you could be quite confident that the ruble should be a safe haven, if we can say call it this way. So this is how ruble behaved. This is the start of the Ukrainian crisis. This is the top, and now it's going down, down, down. Sorry. So you can see, nobody cares about Russia anymore. About Crimea anymore. There is no volatility, is very low. It's following oil. Okay, just wait for the sanctions to be lifted, and this is just jackpot, I think. So this is it. What is the consensus about among houses? Unlike oil pricing, the minimum and the maximum is extremely tight. The range is tight. You don't have this out of the money $35 bet or the $65 bet. Yeah? So you've got something very tight. This is a consensus. Yeah? On top of that, the ruble, if you believe in Russia being back in favor, if you believe in the sanctions being lifted, gives you a great carry. Meaning that if you want to buy Russian ruble now for delivery in 1 year, you buy it at a 6% discount, and this is what the carry means. So, as such, it's a cheap currency also to buy forward. Yeah? So what you can do, if you believe in what was said before, so if you believe in Russia being back in favor, in oil pricing having a positive impact on Russia, you can write this autocallable. So this is one of my personal favorite trades. You get a 10% per annum coupon. Okay, your trade is only on one underlier. There is not worst of story here. The only underlier is short dollar ruble, so long ruble. Yeah. Your barrier is at above 70, so it's 120% of the current spot. And you generate 10% per annum. Yeah? So there are two ways of looking at this trade. Either you believe in the Russian story, and you are investor who is not Russian, and you do this trade, or you are Russian. If you are Russian, usually, from my personal experience, you tend not to trust the ruble so much. You don't like to have rubles in your portfolio or in your wallet. What can you do? But on the other hand, if you have rubles in your wallet, this gets paid 8% per annum in your deposit account in a Russian bank. Yeah? So what can you do? You can take your rubles out, convert it in dollars. So now you've got in the safe money. You invest in this one. That pays you 10% per annum, so 2% above the Russian deposit. This is in dollars. If rubles do not depreciate, you get your dollars back with 10% return. If it depreciates, you get the equivalent of rubles. Yeah? So worst case scenario, if you can say so, you get rubles, but that got paid at 10% per annum instead of 8% per annum. Best case scenario, if we can say so, you get dollars paid at 10% per annum. Yeah? I think this is quite a smart trade to use the carry that the currency gives you. Another quite consensual way of playing this is buying Russian equities. Okay, so here you can mix the previous idea on oil companies with the view on Russian economy. So here you've got a bonus certificate, so I will not spend time explaining a bonus certificate, but here you've got so 3 Russian companies, so a 65% American barrier, okay? Of course, you can go there. Here it went there. Russia is at the bottom. But you got 145% of the participation on the basket. Yeah? So to me, the carry trade on dollar ruble is really worth a close look. So I talked a little bit about Trump, and I'm getting a bit more into Trump again. We talked about the deregulation. Once again, previously, a lot of complaints about Trump. What is Trump worth? What does he know about what he's going to do? But at least what he announced is for sure deregulation. I mean, he's a businessman, right? So there's really a change of policy mix. Before, it was a world with low interest rate, high tax, high regulation. That was the US before Trump. Trump really wants to change this balance into lower tax, lower regulation, and higher interest rates. This is a bit the trade-off, I think, that is happening. So this is what is going to drive the ideas that I'm going to present now. So Trump, it was widely, I think, explained this morning, tax reforms. Also, corporate tax is supposed to go down from 35 to 15. So it's obviously quite competitive. You know about the big plan of infrastructure spending and deregulation. Deregulation, there are talks about removing or loosening Dodd-Frank rules, and also the Volcker rule. Okay, meaning that if this is the case, then banks can go back to prop trading. Yeah? So instead of having a lot of capital just for reserves, this capital could be used to make money. So if you look at the book value of banks, so price to book value, you are in the lowest currently because of regulation. I'm talking only about US banks, not about European banks, US banks. Also, the return on equity on US banks is super low because of regulation. And when you have a pot of cash and you are a US bank, because of regulation, you have to set aside a lot doing nothing. If you can obviously play with it, you are going to generate more revenues. At least this is what you expect. So this is what I mean by this. Yeah. The productivity of the financials should go up if regulation loosens, of course. So how to play it? Via structured product. One idea here, so you take 3 US banks, okay, so Bank of America, Morgan Stanley, JP Morgan. Once again, you can choose any bank you like, US bank, to play this theme. And we place a buy at 60%, American. This is a short-term product, 1 year. And here I'm going to show you the memory autocall feature. Okay, so on oil, I showed you the step-down feature, so that makes your autocall as quickly as possible, so that you don't miss a trend. Here, I'm going to show you something a bit different. So as you know, in the world of autocallable, what you need is all the stocks to be above a certain level in order to be autocalled. Yeah? So I'm sure you had this unpleasant experience of having 2 stocks above, 1 under, and then the next observation date, this is the contrary, you never get autocalled, and if really worse come to worse, you may even touch a buyer at the end, right? So with this feature, we avoid this. So we say, we still need all the stocks to be, or all the underliers to be above the autocall trigger level, but not necessarily on the same day. Yeah? So if I take this example, and this is an example of actually some stocks that we actually traded on. I have 3 underlyings. One is gray, one is orange, one is green. And I've got 3 observation dates, so 1, 2, and 3. So all the stocks start at 100%, obviously. I go to the first observation date. On a normal autocallable, here you are not autocalled, right? Because the worst is here, below the autocall trigger. In my case, it's not autocalled either, because I still need all the stocks to be autocalled, but this one ticks, and this one ticks. Yes? Those 2 made it, okay? I go to the next autocall date, observation date. The orange that was above is now below. So in a normal autocall, unfortunately, you don't autocall. In this version, you do autocall, because the orange, you don't care anymore. The orange ticked here, okay? So you don't even look at it. The only one that you care about is the one that didn't tick before. The one that didn't tick the box before is the gray one. Here it ticks, done, autocall. Yes? So it's called memory fixing autocallable. It's a great product because this feature is actually very cheap from a pricing perspective, using correlation, but in practice, that has a lot of value for you. Yeah? And still paying you 9.5% per annum. I will go towards the 4th theme now, which is USD rates. I think the next presentation is fully on rates, so I will not spend too much time on explaining the context. But still, as you saw in the graphs before, we were in a regime of deflation fears until mid of 2016. Now, with the rise in commodity pricing, not only oil, but more generally commodity pricing, the rise in labor costs, this is true in China, but imagine that if Trump really wants to produce anything that is bought in America, of course, you are going to see this a lot. The policy mix, that is more balanced, as I said, from high tax, high regulation, low interest rates, towards high interest rates, low tax, low regulation. And what we see also is a steepening of the curve. So there is more premium in the longer term rates than in the short term. So this is actually what it has always been before the financial crisis. We are just back to what normality is, right? Because interest rates are 0 are not something quite new. I'm sure you remember your financial classes where rates cannot be negative and you choose if you did some modeling, you always choose a model that does not allow rates to go negative. If I look at inflation, this is a graph you saw this morning already. So indeed, this is the 5-year into 5-year USD inflation. So this is an indicator that most economists and central bankers use. Okay, so this is kind of what the market implies for the 5-year inflation in 5 years. This is forward starting inflation. So the normality, once again, was around 3. Since 2014, there was a drop, so deflation fears. Oops, once again. So deflation fears, right? This is obviously Trump, just here, and boom, back to 2.5. This is US inflation. So deflation fears just got erased in 1 week. As long as Trump got elected, finished. This is more or less the message of this graph. Also, this is pure Trump effect. If I look at the commodity pricing, the impact of commodity pricing, I look at this graph. So what is this graph? This is the US PPI index all commodities, very fancy name. It tells me how much of the commodity pricing is influencing inflation. Yeah? So if it's negative, it means that cheap commodity creates potentially deflation. If it's positive, it means that high commodity pricing potentially creates inflation. So it was in the negative, and now it's getting back into positive. Okay? So the higher oil pricing, for instance, also is kicking into inflation. This is another graph, which is an illustration of what investors think about how interest rates are going to go in the future. If I am an investor and I am convinced that interest rates will never go up, what should I do? I should buy a long-dated bond to get the maximum yield I can and carry it. Because if I am convinced that it will never go up, I'm fine. Yes? So I will not require a lot of premium for this long-term bond. If I don't believe this, if I believe rates may go up to the roof, I will never buy this long-term bond. I will buy a short-term bond and roll, and roll, and roll, and roll, and roll, up to the point where, okay, now I think it's finished, and then I lock the long-term. Yeah? So far, easy. This graph, this is exactly what I said. That means that the term structure of interest rates, if you want, was very flat. People were buying the long-term bonds because they were convinced that interest rates would not go up. Since Trump came in, boom, they're not buying the long-term anymore. They're happy to buy short-term because they believe there is no cap to interest rates, so there is no floor to bonds, so it may be a bit risky to buy the long-term bonds. So better buy the short-term and roll. Yeah? So we've got a lot of indicators, so inflation, this term structure, that tell you that rates may be on the move up. So if we look at the forecast of the main houses computed by Bloomberg, you've got, this is a 10-year USD rates forecast. So you see a trend up. As you probably know, most houses predict in the Fed fund 2 hikes in 2017 and 3 hikes in 2018. So you may feel comfortable that there is some support for interest rates. We have also totally out of the money articles being published. I'm sure you bumped into the one maybe published in Zero Hedge, I think, about those guys, Druckenmiller, Goodler, and Lindsay, saying, okay, we are really, we have full employment in the US. We have Trump, being very aggressive on the tax and on regulation. We may go up to 6% growth in GDP, and if we are back to 6% in GDP growth, we should be up 6% in inflation. So this is 6% for the 10-year yield. Okay, you've got those very out of the money bets. So, of course, if it happens, it's a new world, huh? Because if interest rate is at 6%, you can make predictions on your real estate investments, also equity. Why would people buy equity with 6% interest rate and this kind of thing? So it's worth, I think, being short rates, so having a positive exposure to rise increasing, to yields increasing. And this is what I want to show you here. So it was a very, very successful product in 2016. Due to the rising rates, it paid quite a lot also to investors. So it was really a good investment to be in. Just a BRC on the 10-year swap rate. Okay, so now your underlier is the 10-year swap rate. It's not Nestlé Roche Novartis on the worst of the three. It's the 10-year swap rate. So you look at this, and this is your underlier for the BRC. So if you put your barrier as 60% of the current rate, okay, so the current rate is around 2.4, I think. So 60% of this is 1.3, roughly, right? So a bit more, probably 1.4. So if at maturity interest rates, the 10-year interest rate is above 1.4, you get your capital back without any loss. Plus the guaranteed coupon, 5.5%. Yeah. So pure fixed income, I think also in your allocation, you can go in fixed income. This is if you think rates are not going to go down. If obviously you believe in out of the money scenario, right, 6% interest rates in 1 or 2 years, once again, this is not a view here. It's just, if you believe in this, you don't want this. You want full exposure. And that can be also a great hedge for your equity portfolio, by the way, because if rates go to 6, S&P has some, I think, issues ahead. You can do this trade. So this is the same principle. You have a barrier on the downside at 60%, but your upside is not a fixed coupon, but it is 3 times the rate. So if it prints at 6% in 1 year, if, of course, you get 3 times 6, 18%. Okay, so this is a very leveraged way of expressing a very out-of-the-money view. Yeah, that was a very successful product in 2016, one of the best sellers also. Another way of playing this, maybe in a more conventional format, is to use ETFs. Okay, so fears on inflation, people go to gold. Usually, gold is traditionally seen as the good hedge against inflation. So you can use gold as your underlier. So this is the first one. So you will have gold, and you can use this ETF TBT. TBT is an ETF. The performance daily will be twice the performance, minus twice the performance of the long-term bonds. Okay, so when you are long TBT, you are long rates in the sense that if rates go up, you make money. So this is also a product. So paying you 11.5% per annum. Okay, quite a bestseller, I would say, also this year in 2017, because gold is at low levels, I would say, and TBT also, given the very low interest rates, is low. Yeah, so once again, this thing, 75% barrier. You can see previously it was not touched, but it can obviously, the barrier is 75%, and you generate 11.5% per annum. Yeah. The last theme I want to talk about is volatility. I'm sure you got from the previous presentations that there is a lot of uncertainty. Trump has big plans. This is what we try to express via our trade IDs here. But nobody really knows what's actually going to happen. There is a lot of uncertainty in Europe also, with French elections, German elections. So maybe volatility, and you know since this morning that it's an asset class. Also, you can express views by playing volatility. So first, let's look at the allocation and the inflows between bonds and equity since 2007. Okay. It has been a great trade since 2007 to be long bonds, as you all know, if you are lucky enough to be in the trade. Okay? With rates going down, 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 of course, your portfolio of bonds went up, 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 up. So this is net inflows. So people buying more bonds, more bonds, more bonds, more bonds, more bonds, more bonds. Yeah? On the other side, equity has seen a lot of outflows, okay, accumulated. So people sell, they sell more, 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 they buy a bit more, they buy back, but they sell. Okay? So you can see that there could be, if there is a bit of a shock of interest rates, you could expect a rotation. And if the rotation happens, given how those two allocations diverged, it can be a bit brutal, could be. So you may want some protection against this if you believe that rotation may happen. At the same time, if you are lucky enough to buy S&P at the bottom in, I think, March 2009, you made 17% per annum, okay, just being long S&P. And this is without the dividends. So at 2% dividends per annum, a great performance. Okay, so on one hand, you've got potentially a lot of money that could flow into equity if rates are shocked. At the same time, equity went up 16% per annum since the bottom. Okay, so you want to be in equity, but still, isn't it too late? There is this new president that you don't really know what's going to do, in fact. So what is the best way of playing it? Okay, this is my question. So let's look at volatility. So volatility, so implied volatility. So here I look at implied volatility strike 100%, so at the money for 6 months maturity. Upside 110 and upside 105. Okay, so this is this graph. So if you are an investor and you see this graph, do you want to buy it or do you want to sell it? Obvious answer, you want to be long this thing. 10% volatility, you can see it at some points, but it's very rare. Okay, so you certainly don't want to sell at least upside calls. You want to buy them. So I think a good idea, if you want to keep long the market because of this imbalance of flows, but not having all the downside because of this uncertainty in what's going to happen, just buy an upside call. 110% upside. So this one, for instance, you pay 0.5%. You go to delta of 9. You can. Why don't you buy 3 calls, 5 calls? Okay, you pay 2%. You get 4% delta, 40% delta. Sorry. Okay, so you pay 2% premium. You get 40% delta, so a 40% allocation. Of course, your maximum downside is 2%. You bought vol at the low, so you are long volatility. If something comes out, the market may be against you, but the vol may shoot up, so you may be actually neutral on your call. And if the market rallies, you will, of course, gain even more delta. You got convexity on the way up, yeah, upside call that you buy. And for sure, if the market goes up, the vol may restrike higher, and you may even make money on the volatility. Yeah? So I think, given uncertainty, so this is what the financial newspaper are telling you, and given the implied market that is very low, just buy it as another way of being long the market. So I think now I covered, I've covered most of the themes I wanted to go through. I don't know if you have any questions about any idea. I'm open for questions.
Thank you, Eric. Well, I heard most of the people ask their questions during the break. Has
That's right.
everything been answered, or anyone who wants to add a question? We learned quite a lot. I always thought that Swiss franc was a safe haven currency, but it's a ruble.
It is. It may be.
So it looks like everything has been answered, and since we want to finish later on time, thank you very much, Eric,
Right, thank
for
you.
a great presentation. Thank you.